Hi everybody, Alex Employer from Expert Forex, and I'm quite excited to let you know that we're making very good progress on the Tap Up tool that a lot of our clients have been waiting for. Now on your screen you can see quite a number of our clients have been testing it and we have received feedback from that. So this is the stage we are at. We've had beta feedback. We're going to make the changes that the beta testers have suggested. But the purpose of this video is to take you on a guided tour around this tool and also to get input from you, the potential user, on the functionality that you'd like to see in this particular tool. So let's have a look at it in a little bit more detail. Basically, it is a non-trading EA. It's meant for manual traders and also traders who use the double in a day techniques or the RSI envelope top-up techniques. Any trader that wants to top their deals up to make additional profits. So that's what this tool is meant for. What's nice about it, it sits on the MT4 platform, so it automatically loads up all the critical information you need, such as pip values, spreads, margin requirements, broker minimum stops, account sizes, current price levels, etc. Your proposed strategy is then analyzed in detail, and it is also evaluated whether it is a possible strategy. Now, not all strategies are actually possible because they might not meet certain criteria of your broker or the level of your particular account. It then provides the price levels that you will need to enter on a manual or automated basis if you accept that particular strategy. So let's have a look at the input in a little bit more detail. Now, the first decision you need to make is what risk method you're going to use. Are you going to allow your top-up trades to be topped out at break even, or the other alternative is at the initial risk? So if you're risking $50 on your initial transaction, it will then allow you to be stopped at $50 after each top up. The advantage to that is your stops are a little bit bigger, but the disadvantage is that you are likely to have a minus 50 stop out more regularly. Okay, so then it looks at your account size. It says, all right, this account has that amount of money currently in it. You can refresh that amount to see the amount available for trading. Now, a big misconception is you don't need to use your whole account. You can say, of that, I want to base my trading on only $1,000 of my account. So you base your trading not on the full balance, but you can base it on a smaller amount. Now, if you're going to use that smaller amount, you might risk 5% of that amount to make 100% of that amount. So a lot of traders think they always have to risk their whole account. You can actually control that. Then what the input provides is entry price information. Now that is the current price that it then looks up. Alternatively, you can type over that and give a price that you want to enter at as a pending order, and it will then work from that particular price. And it will also then say, or do you want to buy from that price or do you want to sell from that price? So if you click on buy, such as the case here, it highlights buy, it will do the calculations for buying. If you click on sell, it will do the calculations on selling. Then the normal thing is you say my take profits will be 100 pips, it's in pips, and my initial stop loss will be, say, 20 pips. The minimum stop level is basically what you want to see as your minimum stop level, and you can enter that in over there. And then you say, where do you want to stop up? Do you want to stop up 35% on the way to the target, 50% on the way to the target, and 65%? Obviously, you can vary those percentages. In fact, if you only want to top up once, you enter there and you just leave those blank. If you want to enter twice, you enter those and you leave those blank. So after you've done your input, you then click on show result. And the results will then be displayed to you in quite a lot of detail. And I'm going to go through those results because in order for you to give us feedback, you need to understand how this calculator is going to work. So it basically tells you you're about to trade the pound USD. Your anticipated trend is 100. The amount that you're going to use of your account is 1,000. You're going to risk 5% of that amount, and your reward will be $1,000 or 10%. Or 100%. The current spread is that number there, and the pip value is that number there. So it looks all of that up for you, and then it tells you the margin charged by the broker is that amount for every main lot. It will also look up whether the broker has a minimum stop level. Normally brokers have a minimum stop level of about 10 or 12. Now what that means is that you cannot put your stop closer than your broker's minimum stop level, and it will then look it up. In this case, the broker doesn't have that restriction. Most brokers have that particular restriction. So there's the basic information that it then supplies you, and then it says, okay, we've now gone away and we've created the trading plan that you've asked for, and here it is. If you want to double the amount of your account that you're using, you would have to do it in this way. You would have to use so many lots for your initial trade, so many lots for your top up, so many lots for your next top up, and so many lots for your final top up. Your pip gains will be that, but your dollar gains will be that at each particular point. So if you add all of that up, that's where the 1,100 comes from. And if you get stopped out, you will be stopped out on your initial trade at minus $50. On your first top up, you'll be down $1. On your next top up, you'll be actually up $2, and on your final top up, you'll be up $7. So this means that basically after your first top up, the transaction becomes relatively risk-free. So that's the strategy that will be applied based on the input that you've given. The calculator will calculate your break-even stops for you. And here it shows the break-even stops. They're called margin of safety because that's what a stop is. It's just a margin of safety. And the initial stop is, as we've seen, 20. The break even for the first top up is 16. Break even for the second one is 15, and the break even for the third top up is 15. So what it means is if those top up stops are hit, all the total transaction will be at break even in this particular case. Okay, so that bit of information is then supplied, and then it also goes away and looks at the account size required. Now, this is very important for European traders and US traders where margin starts playing a big role. So it basically says you need so much in your account to finance your first trade, you need so much in your account to finance the first top up, and so much in your account to finance the second top up, and so much in your account to finance the third top up. So immediately you know you're safe. You're only using 1,000 of your account, and you only need that much when topping up. That amount is not only margin, but it actually calculates the amount you need to finance the deal at the point that you are stopped out at break even. In other words, it does take the profit that you've made up to that point into account, and that is the maximum amount you need in your account to finance the total transaction. Now, for manual traders, it then supplies the actual price level. So you can literally copy this into your trading platform. You can load an initial trade with those details. You can then load a pending order with those details, a pending order with those details, and a pending order with those details, and enter those in. The only thing that you cannot do is when the first top up happens, the stop loss should be then. You should move your initial stop loss, your initial trade stop loss to that same level. When your second top up happens, it's at that the break even stop is at that level. Both these previous two transactions, both those two transactions have to be manually moved to that level, and so on. So, but this is a good kickoff. It shows you where to enter your pending orders and your market orders depending on what style of trading you will do. And it says the risk on return is 20 times. So in other words, you're risking 5% to make 100. That's a 20 times return on your risk. So that is the current top-up calculator output. We have had some feedback from our beta testers, and I'll just go through that feedback for you. Firstly, there are 3 conditions for a valid strategy. The first requirement is that these stops over here need to be fairly balanced. Now, they're not really balanced. The variation is 20 to 15. That's quite a big variation. What is required here, you should actually move your initial stop to about 18. All those other ones will then move up, and you'll have a more balanced strategy. So the first evaluation, you need to have a fairly well-balanced strategy. So that's number one. The other one that you need is you need enough money in your account to pay for the margin. And it will then look at this and say, yes, that amount is much lower than what you're trading with, and therefore you have enough money in your account. So that's the second thing you need to evaluate. And then the third thing you need to evaluate is, are these stops above your broker's minimum stop level? So what we're going to do now, the beta tester have told us, has given that feedback and said what we need to do is put a traffic light kind of system where you have green light, green light, green light if it meets all those criteria, and if it doesn't, it will have a red light in the criteria that it meets. And then you have to go back to the input and play around with either the risks that you take, with all the variables in that input, to create a strategy that has green lights all over. So that's the one change we're going to make. And the other change is the percentage risk here is based on the amount you are going to use out of your account. We're going to add 2 more lines there to say the risk on the total account and the reward on the total account. So you might be risking 5% on the amount you're using, but on the total account that might be only a risk of 2%, let's say. And your reward, although it's 100% on your amount that you're using, it might only be 25 or 26% of your total account. So we're adding that bit of information in as a result of input from our beta tester. So other potential changes that we're considering, and at this stage, as I say, they are being considered, using the calculator to load the transactions into the account. So in other words, instead of manually inputting these price levels as shown there, the calculator would load those into the account for you. The other thing that we are looking at, and all of these are not guaranteed to be in the final product at this stage, but we are looking at this upgrade, is that the calculator shows the trade levels on the chart. So in this case, we're going to be on the pound chart, and it's going to have all of these details in there, and you would like to see those trade levels actually shown on the chart. So that's another thing we will be looking at. So I hope that's given you a good idea of how the top-up calculator will work. It's very powerful because it takes margin and broker requirements and all kinds of things into account, and automates a lot of lookup items such as spreads, values, and all that type of thing. So we're quite happy with that. But please tell us if there's anything we have left out that will make your trading a lot easier. Just bear in mind, this is not a trading EA. At this stage, it is a calculator that sets you up for trading, but it will not trade for you. It will not monitor the transaction. It will not move those break-even stops to where you want it. At this stage, we are presenting it as a calculator for manual traders as well as traders that want to use the double in a day EA or the RSI envelope trader that uses top-up concepts. So from me, Alex de Proy, cheerio.